Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place.
I'm Hayden Brain, and welcome back for another episode of Opto Sessions. A pre-eminent chronicler of financial crime, in 2013, Liam Vaughan led a team of reporters in the uncovering of a conspiracy to manipulate the $5 trillion a day foreign exchange market, and has since covered high-profile white-collar crime on behalf of Bloomberg. On the release of his latest book, Flash Crash, the definitive account of one of the most mysterious events in recent history, I asked Liam, can we solely ascribe blame to just one individual trader for this trillion-dollar market crash? How did a 36-year-old trading out of his parents' house dupe the US government and global financial markets? And how likely is it that we'll see another flash crash in the near future? Liam reveals all on today's podcast. Hello to everyone listening. Today we're lucky to be joined by Liam Vaughan, award-winning journalist and senior reporter with Bloomberg and Business Week magazine. In 2017, Liam penned his first book, The Fix, which tells the inside story of the LIBOR scandal. And on the 10-year anniversary of one of the most dramatic market crashes in history, Liam has just published his latest book, Flash Crash, the real-life story of Navinder Sarao, accused by the US government of helping to cause a $1 trillion stock market crash on May 6, 2010. So welcome, Liam. Great to have you on the podcast.
Hi, Hayden. Great to be on.
Good stuff. US stock markets have recorded historic one-day losses during the pandemic over recent weeks. And I believe the S&P 500 actually registered its greatest weekly gain in decades this April. But all of this comes after 10 years after a $1 trillion stock market crash on May the 6th in 2010, as I said. So for anyone that doesn't know, can you just tell us what happened on that day?
Yeah, so May 6th, 2010 was a fairly tumultuous period in financial markets. It was in the middle of the Eurozone crisis, and you had, bailouts of Greece going on. You had governments propping up banks in the countries that were known as the pigs, so Portugal and Italy and Spain. And, throughout the days before and leading up to May 6th, markets had been very volatile, and particularly that morning as well. There was a lot of kind of macroeconomic events happening. I think it was the day of the UK election, and leading into the afternoon, markets were very volatile, but no more than there had been on various other days, and certainly no more than there had been during the couple of years before when it was the financial crisis. But at 1:41 p.m. Central Time, the bottom just suddenly fell out of the market, and the S&P 500 plummeted 5% in 4 minutes, which was the fastest and most dramatic short-term crash in its history. $1 trillion was wiped out off the market for that period of time. And the move was so fast that the CME actually stopped trading for 5 seconds in index futures at that point in time. And then almost immediately after that, you started to see individual stocks trading in very, very weird ways. You had some stocks that were changing hands at like a fraction of a cent. Others were suddenly changing hands at $100,000. One of the bizarre things about it is that, within half an hour, markets had started to, and increasingly recovered to the period that they were before the bottom fell out of the market. So if you were coming at it blind and you'd gone to have some food or something, and you looked at the market 45 minutes after 1:41 p.m., you might not even know that anything had happened. But for that kind of 45-minute period, it was like sort of staring into the abyss, and nobody knew what had happened, whether it was going to happen again, and even why the markets had bounced back at all. So, from the perspective of market observers, unlike other crashes, this time prices bounced back. And so the actual losses to people were contained, although some people did take losses. But it was more what it signified in terms of drawing attention to the way that the structure of markets had changed, and increasingly markets were inhabited by electronic and high frequency trading firms. And so there was a real scrutiny after the event on that. And that was the significance, really.
Yeah, sure. And in your book, Flash Crash actually details those events and kind of takes it from the perspective of Navinder, as I mentioned in the intro. I wonder whether you could give us a quick précis of what the book's all about.
Yeah, so the book Flash Crash tells the story of Navinder Sarao, who is a kid from Hounslow in West London, pretty modest upbringing, went to the local school, loved playing football with his mates, loved, computer games, bit of a lad. And after university, he was kind of bumming around, unemployed, and he applied for a job to be a futures trader. And, fast forward 5 years, and he was already worth £2 million. Fast forward another year, and he was worth £15 million. Just incredibly gifted at a type of trading called scalping. But in 2010, he was active on the day the market collapsed, and 5 years later, he gets a knock on the door in his parents' house. He's in bed, he's asleep, and it's the FBI and a bunch of police officers, and they're there to arrest him for manipulating the market and also contributing to this dramatic event of 5 years earlier. So my book really tells the story of how this very unlikely character, who was, about as far away from high finance as possible, goes from a standing start to being worth $70 million, and he ends up in the crosshairs of the American government.
Yeah, sure. And as you say, we'll dig into that in more detail shortly. I'm sure that's worked pretty well to whet the appetite of our listeners. But first of all, I just want to take a step back and just kind of try to understand the work that goes into a book like this and your investigative journalism more generally. You've been a chronicler of financial crime for some time now. How did you get into writing about this intriguing underworld?
So I joined Bloomberg in 2011, having been a financial journalist for a while. I'd covered the financial crisis, and suddenly what used to be considered quite obscure and esoteric was very much in the mainstream. It was the banking crisis, and everyone was talking about Lehman Brothers and RBS and bailouts and all that stuff. So suddenly finance and banking was the story. And not long after joining Bloomberg, there started to be a real kind of uplift in the amount of action taken against institutions and traders that were accused of wrongdoing. Suddenly there was a lot of anger, about some of the conduct within these institutions. So the first thing that I covered was this thing called the LIBOR scandal, which I wrote about, as you mentioned, in my first book, which was essentially kind of traders at different institutions coming together on chat rooms and talking about how they were going to nudge interest rates to profit their own positions. But in doing that, they were kind of fiddling around with this really important interest rate that's baked into huge amounts of derivatives and financial products. And shortly after that, we had a tip-off about wrongdoing and shenanigans in the foreign exchange market. And so, we ended up focusing on that. So it wasn't necessarily a choice that I wanted to cover kind of white collar crime, but they were always the most sexy and exciting stories, to be honest with you. Just understanding like how this worked and who these people were, and what tempted them, what was the sort of psychology behind otherwise very smart and well-educated people and successful people taking these decisions that ultimately landed them in trouble. It was just really fascinating to me. And so from that point on, I increasingly focused on that kind of stuff. And Bloomberg loved it. People want to read all about that stuff. And it was shortly after that I took a position essentially just covering white collar crime on a full-time basis and doing more of the kind of investigative journalism that you're talking about, which is, spending weeks and sometimes months on a single story and writing something very long and hopefully compelling at the end of it.
Yeah, sure. And as well as being, particularly sort of compelling in its own right, I mean, your work really is great. It results in significant repercussions for the subject. You talked about uncovering this mass manipulation of the foreign exchange market, but I believe that led to sort of 10 billion in fines for some of the biggest banks in the world, banks like JP Morgan and Barclays. So I just wondered, sort of from a personal perspective, how it actually felt to sort of unmask some of these perpetrators.
I mean, that was a really surreal and probably like a once in a career situation where we had a tip off after we'd written a bunch of stories about LIBOR that there was also this benchmark rate that was used in foreign exchange markets. It was set at 4 p.m. every day. They're called the WM Reuters 4 p.m. rates. And we had a tip off that banks, similar to LIBOR, were sort of coming together on chat rooms, discussing their positions going into this fixing, and then sort of talking about how they plan to kind of work together to move it in a way that suited their positions. And so we managed to stand that up. We wrote a couple of stories at the time, and they were almost met with either criticism or silence from the industry itself. You stand by your reporting and you believe in it, but you never know quite what's going to happen. And then 6 months later or something like that, they basically confirmed that they were doing this big investigation into exactly what we were talking about. And then within like a few days, regulators all around the world had said they're doing exactly the same thing. And through reporting that story in the weeks that followed, lots and lots of traders at different institutions started to be sacked. And we ended up, trying to report that out as closely as possible. And it turned out, in particular, there was one chat room that the members had called the cartel, which I think they could, they named it that as a joke, but it obviously came back to bite them. And it was these big traders at some of the biggest players in foreign exchange markets had this chat room, and they would talk about their positions going into the fix. So it wasn't like, hey, we're going to go after the cartel, or we're going to get these guys. It was more gradual, and it just turned out that we weren't just right, but we had stumbled upon this monster, really. And as you say, like over the next kind of couple of years, various financial institutions, including JP Morgan, UBS, Barclays, all paid hundreds of millions of dollars in fines. And yeah, the total amounted to $10 billion. I mean, from our point of view, or from my point of view, I think that you're motivated, or I'm motivated by the story and by kind of shining a light on markets which quite often are hidden and benefit from that. But you also, from a personal point of view, feel badly for some of the individuals that are caught up in it. So I don't see myself as like some moral arbiter that's trying to take out these individuals or anything. It's more about shining a light on the market and hopefully making markets a better place and ultimately, writing a great story.
Yeah, for sure. I mean, that makes complete sense. So then to move on to your books, the two novels that you've written, you've referenced The Fix and obviously Flash Crash as well. I just kind of presumed that to get access to the subjects that you're talking about, particularly if they're involved in complex legal suits or some of them even in prison, I mean, how do you go about getting access to these people and their inner circle?
You're absolutely right. Like probably the hardest part of the job is getting people to talk to you. And there's no kind of single way of doing that. It really is a case of immersing yourself in the subject matter to such an extent that you become credible and that you can talk to these people, maybe not on their level, but close enough that you really understand and can sort of comprehend what they're telling you, and that they appreciate that you're not just after, writing a quick sort of scoop. You're actually trying to really understand the market. And then it's really a case of tenacity. I'm working on a story at the moment, very fresh, and it's just a case of like trying to draw up a list of as many people as you can and hitting them all up. And one or two normally come back, and then it, in my experience, it sort of snowballs, from there. They'll tell you someone else and they'll tell you someone else, and eventually over time, you get enough, and then it reaches almost critical mass whereby people almost have to talk to you because they know that you've got the goods and that you're going to run the story anyway. And it's kind of a calculation that people will make, that ultimately it's better to try and influence any article than to stay quiet. And I think that's probably a good judgment in the end, but not always. So yeah, and the other thing I'd say is that everyone's got different motivations. Some people just really love the idea of being part of a story and it's fun, and talking to me about, their life is just interesting on some level. Other people are really motivated because they believe that the way something's been covered, this was definitely true with the LIBOR book, was inaccurate. They wanted to kind of right the wrongs and explain the nuances of the market rather than this sort of cartoon version that had been out up until then.
Yeah, sure. Sort of gives them an opportunity to sort of provide their side of the story, or at least correct some errors potentially. I mean, that makes complete sense. I guess then I want to quickly then sort of move us on to dig into the detail of your latest book, Flash Crash. And I wanted to focus on the protagonist, Navinder Sarao, and kind of what made him such a prolific trader. 2 years out of university, Navinder starts to work for a small UK trading arcade, Futex. Safe to say he took to it like a duck to water. I mean, what about Nav meant he was able to start trading and understanding financial markets so intuitively?
So Nav and Futex in general focused on a style of trading known as scalping, which is really, and I'm sure your listeners will know this, but it's really sort of very short-term focused. So he's not trying to find what stocks are going to go up or looking at interest rates and trying to sort of use economic analysis to determine which way the markets are going to move, next week. He was focused on something called the ladder, which is basically shows you all the orders coming into the market and all the bids and offers in the market waiting to be consummated. And from that thing called the ladder, you can use that to discern which way you think the market is about to move. And you can sort of get in and out for a couple of ticks. And, it's a very frenetic style of trading. And it just absolutely suited Nav down to the ground. Like before he joined Futex, he was like obsessed with FIFA. And would just like sit there and play FIFA for literally tens of hours at a time. And he got into the top few hundred in the world. And it shows you his dedication, his ability, and also his kind of dexterousness, that he had that sort of hand to eye coordination. He was also had like a photographic memory. And a lot of what he was doing on the ladder involves kind of complex calculations very quickly, making assessments on whether the market's about to move based on what he's seeing in front of him and what he's seen before. So he had, those two elements to his game. But the other thing is that by personality type, he was very obsessive, and he would later be diagnosed with Asperger's syndrome. But, that had sort of negative impacts on other aspects of his life. Like he was incredibly absent-minded, always losing things, falling off his moped. But he was like able to sit there in front of the ladder for hours and hours and hours at a time. And so that sort of focus is really hard to teach, but Nav just had it naturally.
Yeah, that definitely comes across in the book. I mean, from the outset, Nav displays almost a limitless appetite for risk. I mean, ever increasing lot sizes don't seem to faze him. Does that give him his edge, at least for a time?
Yeah, 100%. Anyone that knows anything about the story knows that Nav, what he became famous for is that he just didn't spend any of the money. So he, wore the same tracksuit for days at a time, lived on McDonald's. And when the FBI knocked on his door, his parents didn't know that he was worth $70 million. So it's almost like a bit of a tragic element to the story. But the thing about Nav is that he, whether it was his kind of Asperger's or just his personality or whatever, he just didn't have any real material desire. Like he didn't want a fast car, he didn't want flash clothes, and he didn't even tell anyone he had the money. So it wasn't about status and ego. It just seems that for Nav, it was really about testing himself, proving that he was capable and proving that he could be the best at trading in the world. And he had this massive advantage, which is that if he had conviction in a trade, he wouldn't be fazed by putting, X% of his bankroll on the line. He would just take the decision. And if it went against him, he would just dust himself off and come in the next day and build up from scratch. Whereas most people, might have a mortgage or have a family or, just psychology, like, oh my God, like I've got so much on the line here, I've built up for it over time. And Nav just didn't have that. And, would come in sometimes, lose tens of thousands of pounds, and nobody would know about it because he just didn't show it and was able to just kind of absorb it. So he had this bizarre and unique psychology, which you see in really successful, like high stakes poker players. And, he had that. And I definitely think it was a major asset.
Yeah, that seems definitely the case. I mean, you talk about his motivations there. He's, I guess, presented both in the book and in the wider media around the story, sort of completely unmotivated by financial gain. I mean, I believe actually that helped him to get potentially a more lenient sentence when he was later convicted. I mean, his biggest splurge while at Futex, I believe, was a VW Golf that he quickly got bored of. And, bearing in mind at this time, he was taking home sort of hundreds of thousands of dollars at a time. I mean, is that a fair assessment in your opinion, sort of completely unmotivated by financial gain?
It is, yeah. I mean, it's almost like more nuanced than that, because he's unmotivated by the things that money can buy, but he's obsessed by increasing the amount of money that he's got. And I'd quote him in the book, but he talks about seeing markets like a computer game, albeit a really hard and insanely complex computer game. But that is how he saw markets, and therefore his profit and loss to him was like a high score and a badge of honor and representative of how good he was at trading. And it just didn't translate into, well, he could use this money for anything he wanted to. So I do think, yeah, your assessment is absolutely right. But I don't think he didn't necessarily care about the money, because he did obsess over increasing it, but just for no end other than for the sake of it.
That seems definitely the case. I mean, we talked about his gaming proficiency. So I had here he was in the top 700 of the 3 million FIFA players playing globally. So safe to say, he was pretty proficient at FIFA. Was trading a game for Nav then? This series of sort of ever increasing lot sizes and things, it almost bears a resemblance to sort of leveling up in a game. I mean, what's your take on that?
100%. Yeah, he talks about that himself, that he saw markets like a computer game, and that if he won, then it was a bonus. But really, it was just like playing FIFA or, Halo or one of the other games that he enjoyed playing. I think that, the thing about trading, the addictive thing about it is, unlike with computer games, you can't really solve the markets. Like, they constantly throw up new challenges, new dynamics, new competitors. And so I think that if you're that sort of addictive personality that loves competition, that loves challenge, then financial markets are almost like the ultimate game for him.
Yeah, and it seemed almost that the markets, and we've kind of touched on it already, gave Nav a sense of meritocracy he wasn't afforded in other aspects of his life. I mean, do you think in any way he was driven by that sense of sort of anti-establishment sentiment?
I do think that, yeah. I think one of the things that, the impressions that you'll get from the book about Nav is that he, despite having all his talent, does have a bit of a kind of resentment, some other kind of market participants, or whether it be the people at Futex that he falls out with, whether it be certain brokers not giving him the right price. I refer to some of the posts that he placed on a forum, which are kind of a really funny read and gives you real insight into his character. But there's also just a sort of bubbling sense of him not being taken seriously, him not giving the respect that he deserves. And I think that, later on in the book, when he starts to make serious amounts of money, he would show up to meetings with bankers and with lawyers who wanted to talk to him about investing his money. He would show up an hour late with a bag of McDonald's in his hand. And it's almost a bit of a kind of, two fingers up. Like, I'm now at the point in my in my career that I could sort of do what I want. And I think he enjoyed that.
Yeah, definitely. I mean, that might be a good juncture then to move us on to high frequency trading, only because obviously the market participants that he was potentially sort of rebelling against and feeling almost vindicated by were often, or at least in his head, were often these high frequency trading machines. I mean, the introduction of HFTs at the turn of the millennium certainly seemed to upset the sense of meritocracy that the markets offered Navinder. But briefly, before we go into that, perhaps you can sort of quickly explain what high frequency trading is for anyone that doesn't know.
So high frequency trading is quite a broad spectrum, and people understand it in different ways. In my book, I use quite a specific definition, which is used in kind of academia about the futures market specifically. And it refers to a style of trading which is very, very high volume, but with ever really accumulating a sizable position, constantly buying and selling. So you're never accumulating a large position for any length of time, a few minutes at most, mostly a few seconds, sometimes microseconds. And then you end every day flat. So you're not taking any positions into the next day or the next week or anything like that. And HFT kind of arose in the markets gradually over time. Like in my book, I talk about the history of markets, and the pits start to close kind of in the late 90s. And at first you have everyone jumping onto screen-based trading, but they're still human beings buying and selling. They're just doing it via a computer. And then gradually you have the kind of creeping arrival of these firms that are making much more decisions autonomously without any need for kind of human interaction at all. And I make the analogy in the book that HFT of the type that Nav was critical of wasn't too much different to what Nav was doing in his own brain, looking at the order book, looking at orders coming into and leaving the market, who's buying, who's selling, what price they're willing to pay and sell at, and using statistical analysis to determine whether the market was about to blip down or blip up, and then using very, very fast computers and technology and access to the exchanges to jump ahead of that move before anyone else. And one of the really interesting things that HFT firms are able to do is trade in such a way that if they take on a losing position, they will monitor the cues behind different price levels that will allow them to get out of a losing position without losing money. So it became like this fine art that you could almost trade in a way where you didn't lose. Obviously, the technology was expensive. Hiring these kind of super smart PhDs was expensive, but the actual trading itself, you could solve, and it almost became like a game for these HFT shops as well. And they go from being a very small part of the market to very quickly taking up more and more of the market volume, to the point where by about 2011, more than 1 in every 2 trades passed through the hands of one of less than 30 HFT firms globally. So they would just position themselves between all the trading that went on between big banks, hedge funds, and other more traditional kind of financial players.
Yeah, sure. I mean, and that kind of battle between HFTs and the more individual sort of smaller firms, prop traders, individual traders, things like that, is kind of a frequent and prominent theme throughout the book. I wondered then whether we could sort of get your take on sort of how much blame can be ascribed for the flash crash to HFTs.
Yeah, so one of the things that I try and do in the book is kind of know my limitations. So I spoke to people from all interests and stakeholders within what happened that day, from finance professors that had devoted years to analyzing the trading data, to the market participants, to the HFT firms, to the regulators. And I try and sort of straddle a line and explain the differing perspectives. I mean, on the subject of HFT and the flash crash itself, I mean, one of the things that happened that day, and the reason the market fell in the way that it did, is that liquidity basically evaporated from the market. And what that means in practice is there was nobody willing to stand and buy as the market tumbled. And critics of high frequency trading would turn around and say, well, one of the things that HFT industry participants will say is that we bring all this liquidity to the market, which means that everyone can get in and out of trades more cheaply and more quickly than they could if we weren't around. But what critics will say was, well, as soon as things got really messy and you were needed to sort of stand and take the other side of the trade, you kind of disappeared. So I don't think anyone would say that specifically HFT caused the flash crash, but more the fact that such a high proportion of the market was now dominated by these HFT firms meant that when there were these other factors at play, for example, this massive sell trade that was placed by this fund called Waddell and Reed, when there was spoofing from the likes of Nav and stuff, maybe if that had happened 10 years earlier, the market wouldn't have tanked the way that it did. But because it was increasingly dominated by these algorithms that had signals whether to buy or sell or to leave the market, that exacerbated the problem.
Yeah, that's definitely fair. I mean, yeah, I'm with you on avoiding coming down either way on this. It's a complex subject, but HFTs are actually, I mean, you talk about spoofing there. They're disinclined to spoof or sort of falsify trades, as essentially at least from my understanding, it disrupts their algorithms that are actually obviously better at interpreting the intention of other market participants, if those intentions aren't disguised in any way. So we now see sort of HFTs, big institutions that back them, actually identifying and helping to prosecute individuals or smaller entities that are spoofing. I wanted to get your take on sort of the fairness of that practice, and kind of what's your take on that? Does that lead to an unfair imbalance in the market, perhaps?
Yeah, so it's a debate that I get into in the book. If you imagine that HFT robots, for want of a better word, are monitoring everyone that's placing an order and all these orders coming into the market, constantly shifting numbers on a screen, and have got very sophisticated models that allow them to parse that data and make judgments on whether the market's about to move, in which direction, by how much they should buy, how much they should sell. But for that system to work, it relies on those orders coming into the market being fair representations or accurate representations of what people actually are planning on doing. So what Nav does, in quite a sophisticated way, using his own algorithm, which he called the Nav trader, is he starts distorting the signals that these other participants are reacting to. So he starts placing huge volumes of sell orders. And if you're a robot looking at buying and selling and the imbalance between bids and offers, that is information that you can use to determine whether the market's about to go up or down. So what spoofing is essentially kind of tricking or lying to other market participants about what the market's about to do. In terms of whether it's fair to have a ban on spoofing, there's definitely different schools of thought. One of the main critics of the rules on spoofing, or some of the main critics, would argue that markets have always been about competition between opposing parties who, historically, whether it was in the pits or whether it was in this, place called Exchange Alley in the 18th century back in, sort of foggy London, they would lie to each other all the time, and you would know that the other party was lying to each other. And it's sort of part and parcel of the cut and thrust of financial markets that deceit and lying about your intentions was expected. And ultimately, as long as you were willing to stand by your order, if you got hit, then you get hit. So it's not a fake order in that respect. It is an accurate order. So critics would argue to suddenly impose this rule that you can't lie or you can't place an order and then cancel it was just antithetical to the whole history of the markets. But on the other side, supporters of the new rules would say that, well, actually, this is something that's necessary since more and more markets have gone on to, have become electronic, and you can see now where orders are in the book in a way that you couldn't before. So actually, spoofing is a necessary way to combat something that's very disruptive to the market and actually can cause real world destabilization and losses to people. So there's definitely schools of thought on one side or the other, but it is interesting, and even the investigators and the regulators would concede this, that the biggest beneficiaries of the anti-spoofing rules are the large billion-dollar HFT shops. And as you rightly point out, in the spoofing convictions and cases that have come forward, the witnesses for the prosecution, for the government, are the likes of Citadel, which I think I referenced in the book made $1 billion from just HFT strategies alone in a single year. And if you're a retail investor, or if you're a pension fund or what have you, are you really getting impacted by a 1 or a 2 tick move in the market, or from the indication of where other people are going to trade given by the order book? You're not really looking on that time horizon. So I could definitely understand why there's some controversy around the spoofing rules.
Yeah, it really is a fascinating debate, and covered extremely well in the book. I mean, it does seem that there's sort of a status quo that's being preserved by the fact that these HFTs are sort of embedded within the sort of judicial and persecutory sort of investigations into spoofing. I mean, but it's not a question that will come to answer today, I don't think. But a really fascinating debate.
Well, and one more point on that,
Yeah, of course.
There have been a bunch of HFT operators and firms that have been charged with spoofing as well. So it's not just the case that that they benefit. The waters are even more muddied than that.
Yeah. Okay, great. Well, I wanted to move us on then to the events of the flash crash. What happened on that day, and back to sort of Nav and where he is in the book at the moment. I mean, he was quickly frustrated by the lack of capital and sort of frequent restrictions being placed on him by a few Texas owners. So he strikes out on his own. He's even developed a homemade sort of auto trader algorithm, which he later then actually goes on to upgrade with significant effect. I wondered whether you could give us a brief understanding of how this auto trader algorithm actually helped to crash the market on May 6th.
Yes, so whether it crashed the market or not is definitely up for debate. But what Nav did is in 2008, he becomes so frustrated by the advent of algorithmic trading and the impact it's having on his profits that he writes to a programmer and gets them to design for him a spoofing machine which essentially will just fire very large sell orders into the market a few ticks away from the best offer at the time. So they're unlikely to ever be hit. But at that point in time, the kind of algorithms of some of these HFT shops and others were so rudimentary that they would just look at the total balance between bids and offers in the market. And if they suddenly see a flood of sell orders, then they're going to start selling as well because they expect the market to go down. And anticipating that, Nav would manually also be shorting the market. And then once the market had fallen by 2 or 3 ticks, he would then just start buying back the same amount of futures, close out his position, and 5 minutes later, he would have made, tens of thousands of dollars. So he gets this machine and it's kind of fine-tuned over a period of time, and it's finally sort of really working at its best in 2009 and 2010. And in the days leading up to the flash crash, he's starting to make really ridiculous amounts of money. So I think in the week before, he makes $850,000 in one day, $400,000 the next day, $700,000 the next day. So he's making literally millions of dollars in a week using a home PC in his bedroom. And then on the day of the crash itself, he uses this machine in a more dramatic way than I think all apart from one single day in his entire trading career. So he just really starts cranking up the size of these sell orders. So at one point, he's placing $200 million of sell orders in the S&P 500 E-mini. And this is all coming on a day in which, as I mentioned earlier, there's all these swirling macroeconomic conditions, extreme volatility in the market. And then a really crucial piece of information is that he actually switches off his algorithm and stops trading at 1:40 p.m. And the bottom falls out of the market at 1:41. So, defenders of Nav will say, well, look, he wasn't even active at the point when the bottom fell out of the market. And a minute is a hell of a long time in modern financial markets. The government would say, yes, but he had such a disrupting event. He was using this spoofing machine to put all these sell orders in for such a long period of time, for such a sustained impact, that it ultimately contributed to what went down that day.
Yeah. That's really interesting, and I wanted to get into the more sort of macro context as well. You talked about the events surrounding the crash a little earlier. You've got central banks propping up national economies post the crisis in 2008. That results in a bounce back in global stock markets between 2009 and then just before this flash crash, in April 2010. But in doing that, you've got the pigs, Spain, Italy, Greece. They're all saddled with huge levels of debt that we all know about. And then that has ultimately left the future of the European Union sort of hanging in the balance. So, just from a macro perspective, was it a perfect storm?
Definitely. I mean, it was an unusually volatile marketplace, and undoubtedly, as you mentioned, it was the kind of a sharp end to this rallying that had come about because of the central bank action over a period of months prior to that. But what I would say is that there are other days in which markets are just as volatile, and there's definitely days where the total size of the fall over the course of the day is greater, reflecting all these kind of downward pressures. And even at the moment, you're seeing a combination of the virus and the impact on the economy, and even though some people argue not enough, all of that is leading to massive falls in the global stock markets at the moment. But the thing that was so striking about the day of the flash crash is that the bottom fell out of the market in a way that it never had before. It was the speed and the drama of the fall that was so concerning, because it looked like it might not stop, and that was the thing that was, I guess, that was most frightening. One thing that we haven't got into, which is an important part of the story, is that in Kansas City on that day, there was a large asset management firm called Waddell and Reed that had built up a large stock position and had benefited from the rally. But on that day, the fund manager became so concerned about what he was seeing, all these kind of noises from Europe, that he decided to hedge that position by selling a bunch of E-minis. And he ordered his traders to sell 75,000 E-minis, which had a value of more than $4 billion. And the way that those traders executed that transaction has been the subject of a lot of scrutiny, and for many people, it's the kind of main trigger for actually what happened, because rather than placing like a minimum price that they were willing to accept for those E-minis, they just put in a very simple algorithm that would sell at a rate of 9% of whatever the market volume was. And because that day everyone starts trying to exit their positions, and there's a huge volume of trading going on because there's so much activity, it actually accelerates the speed with which this algorithm starts selling E-minis. And it's just a huge trade. It's like the biggest trade of the year, and it arrives, in the words of Gary Gensler, it's like, he uses the words of like flying into a ravine or something. So essentially, they turn that algorithm on at 1:30, 10 minutes before the bottom falls out of the market, and it continues to sort of sell E-minis for the next half hour, including the period in which the market fell out. So you have all these factors, you have all these macroeconomic factors, you have things that we haven't talked about, including the fact that there was always sort of price delays at the New York Stock Exchange, sort of technical reasons, and you have this massive, unhedged sell order without a limit going in. And then on top of that, you have in Hounslow, in his bedroom, Navinder Sarao, who's, making hay and firing sell orders in at the same time.
Yeah, and on that unhedged sort of massive sell order, there's always seems to be sort of an element of fate in these sort of big market crashes and sort of black swan events, as it were. I mean, I believe the head trader, the guy that would usually put such a big trade through, was actually off that day, and that's why they chose to go with the sort of simple algorithm to execute the trade. Is that right?
He was off that day. Yeah, it was, as you say, so much hinges on fate. And that day, the Kansas City Securities Association was holding an event in a hotel lobby. So the head trader and his team are all having a drink in this in the lobby of this hotel. And yeah, so he didn't oversee the trade, but whether he would have done it differently, I don't know. And to be fair to Waddell and Reed, there were some people after the event that said, trades of that size are regularly placed in a similar way, and the market doesn't collapse in the way that it did. But I think it's quite hard to argue that the way they executed that, in retrospect, was how they would have wanted to do it. Yeah.
Yeah, sure. Um, I guess I just wanted to sort of take a step back then. I mean, some of the numbers that are referenced throughout the book and as part of this crash are mind-boggling, really. I mean, you've got the $1 trillion the market dropped for those sort of 30 seconds or so. You've got the 70 million Nav profited during his career. I mean, it's often easy to forget the significance of these amounts and what they mean for the wider market, people's savings, etc. I mean, how did you find that in writing the book?
It's a good question because, you know, because I write about financial markets as a job, it's quite easy to think of these figures in quite an abstract way. Um, and there's a good analogy, I think, that sort of gets to that issue, which is there's a amazing trade that Nav does in 2008 where he essentially predicts the bailout of the markets, or at least times his trade perfectly for the bailout of the markets when markets rally 19%, US markets rally 19%, and he's long and he makes more than £10 million. And at the time, he's still living at home with his mum and dad, and he gets a phone call from his broker, and his broker's like, "Nav, congratulations! It's just so amazing. You've done so well. What are you planning to do?" And this guy, the broker, used to be in the pits himself, and he has seen so many people not really see the value of the money that they're making and use it sensibly or save or whatever. And he says to Nav, "Look, you've got to do something. What are you going to do?" And Nav's just like, "I'm just going to keep trading." And brings the conversation back to HFT and how he's getting screwed over. And it just gets to the heart of the fact that he just was unable to see money in the same way that most people were. And I guess one of the sad elements is that his mum was still working in a chemist at the time. They've got this very modest house in Hounslow, and obviously he could have really helped them out. In the real world, that sort of money would have made such a profound difference. But to Nav and to so many people in financial markets, it's just zeros on a screen, I think.
Yeah, yeah, I think that's definitely fair, and it is certainly made far more real than that in the book, with a few different passages talking about the impact on certain individuals and their personal savings and things like that. So that actually comes across really well in the book. I wanted to conclude then by sort of talking about what's next. Firstly, for Navinder, I mean, can you talk to us about his sort of current state of affairs? What's happened to him? Where is he now?
Yeah, so I guess to complete the story, Nav gets arrested in 2015 and he is extradited to the US. One of the interesting and fascinating strands of the book is that rather than sort of give any of the money to people that he could trust, Nav had essentially entrusted his money to a series of so-called investment advisors. And when he's in prison, he's trying to get hold of the money to pay bail and he can't get hold of it. Suddenly these people aren't answering the phone, or they give him excuses as to why they can't come up with the money. And so Nav's unable to pay his legal defense fees. And eventually, after he gets extradited, he sort of has to come to the only conclusion that he has to plead guilty to the charges against him. But at that point, his lawyer, a guy called Roger Burlingame, who used to work at the Justice Department, does quite a smart thing. He does a deal with the US prosecutors, and he says, "Listen, Nav will plead guilty to some of these charges, but if you'll go easy on him and show some leniency, he's willing to give you, a look behind the curtain at exactly how he does what he does, how to identify other market cheats, and the sort of schooling on the dark arts of financial markets." And so they agree to that. And then they've actually spent the next 2 to 3 years sitting down with members of the FBI and the US Justice Department with a computer screen behind him, basically talking them through the ladder, what to look for, what he was doing, how to identify other cheats. And it's just an amazing aspect of the story that he ends up basically teaching the US government how to sort of do its job in policing the markets. And on the back of that, a number of individuals and firms have been criminally charged. So fast forward to January of this year, and Nav appears before the judge, and in a very remarkable sort of turnout of events, the prosecutors who had charged him with 22 criminal counts, which had a maximum of 380 years in prison, turn around and say to the judge, listen, this guy shouldn't be in prison. You know, he's a vulnerable individual, but not only that, he's given us so much assistance that it's actually directly led to all these other prosecutions, and therefore we think that he shouldn't get any more prison time. And the judge didn't quite agree, but said, all right, fair enough, we will let you serve 1 year of your sentence under house arrest. So Nav went into under house arrest at the end of January. You know, within a month, the entire world was also in lockdown. So he sort of managed to time that pretty well. In January, that ends. So Nav is at that point a free agent. He's going to be banned from trading US futures for a while. But, you know, maybe he can help some of his friends navigate the markets. You know, obviously, the likes of sort of Nick Leeson and Jerome Kerviel have had a great career on the sort of after dinner circuit talking about their exploits, although I'm not sure that's quite for Nav. So what he gets up to next, I don't know. I'd like to think he'll go back to trading.
Yeah, I think that's probably fair. I mean, so to finish then, I kind of want to get a sense of where your head's at in terms of the future for not just the futures market, I suppose, but the financial markets more broadly. I mean, are you optimistic about increased sort of oversight and regulation through rulings like MiFID II, and you've got FINRA, I believe, in the US? Are you optimistic about that, or fairly, you know, still cynical, I suppose?
I think that markets are more stable now than they were in 2010, and that's a good thing. And there were regulatory steps taken to get to that point. I do think that, you know, in something that's reflective of broader society, there's very much a kind of gulf between the elites at the top of financial markets, participants, and everyone else. And that was sort of borne out by the rise of HFT. And I think that ultimately that's probably unlikely to change. And the way that regulators sort of view their role is to really sort of keep things ticking along as they are and make sure there's not repeats of things like the flash crash, and also people that commit, you know, heinous financial crimes are brought to account. But, you know, is there going to be a more root and branch overhaul of the way markets work that would tackle some of the issues raised, for example, in Michael Lewis's book, Flash Boys? I just don't think there's the appetite for that to happen at all. So, and the other thing I would say is that, you know, a lot of the regulators that I spoke to and the investigators, they were really smart and professional and well-intentioned people. And a lot of the time they were just sort of struggling with a complete lack of resources. You know, to really understand financial markets, particularly now, and the sort of, you know, the nanosecond speed and the amount of data that produces, and the complexity of the types of trading that goes on, you need people with the sort of that background and that caliber. And it's been really hard for regulators to attract those types of people. It just means that there's an imbalance between the people that are actually operating in the markets and the people that are overseeing them.
Yeah, completely. Okay, well, I think that's probably a good place to end. I wanted to obviously point listeners towards your book. I bought a copy on Amazon, but I assume it's available at all good stores and online as well.
Yes, absolutely. You should be able to get it anywhere online. It's available in an audio book version, if you could stand to listen to me talk for 7 hours. And it's available from Amazon and all good booksellers. And hopefully, I'm looking forward to when bookshops reopen and you can buy it in stores as well.
Great news. All right. Well, thanks again for joining us. It's been really fascinating, and hopefully we'll have a chance to speak to you again soon.
Fantastic. Thank you.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.